We're going to see how they break out. And this is the beautiful time to be in these, is when these break higher. And they can make huge moves. You bought at 20 and sold at 70 on 10 contracts, that's $50,000. That's 100 grand if you had 20 contracts. If you had 30 contracts, well, you'd have made 150,000 just during that time frame when the market sold off by having the put side of the S&P fall when it wanted to fall. Now we're coming back into the deflated area. Another one that we're going to be very coherent will be up and out of the money call that we had talked about buying. And we had talked about an up and out of the money, which was a call for 918 to see, you know, it doesn't move like the other contracts. I can blow this up. And we can see the where it was. And it's a very shallow contract. But we're just going to kind of watch that to see how high that might go. It's up 4.55. Another one that we're going to be looking at would be the 918 put option as well, which is $1,100 put that they have just taken from $70. Well, here, let's blow that up. And these are for the September mode when markets can really have a problem. What a great move that was. If you would have bought at 43 10 contracts, you would have made 80 grand. 1, 2, 3, 4, 5. Gap up 6th, 7th, 8th day, you would be selling. You'd be quite happy. Now we're back down here at a deflated area. I am going to take this 1100 put, which is down 1440, and I want alarms set here at $40.80. I want another alarm set at $39.90 and another alarm set at $37.80 on the 1100 put, because when I get down here in that wholesale area as we go through the earnings, there isn't any buyers to support this market, even though it'll be light volume in August. September, the markets can really sell off hard with a lot of tax selling, asset allocation, rebalancing, all of that. So we definitely are not going to take our eyes off of a high was $47.50. It closed at $58. So if I was buying 10 contracts today, I just saved $18,000 of capital on my entry. And basically, we're going to stay on top of it. And the people listening on the video now, the MMT traders that make all this great big money, all the senior traders and new people in the school, can one trade like this, you should have at least 3 of these a year, because that gives you lots of profits. And then as you're trading, and if you have any other losses in the market, so what? This is always the greatest hedge of going the put side, and let us not forget about the call side. The call side pays just as well at times. As you can see today, the 1070 call is up $12. So 10 contracts intraday here, it's $12,000 in 10 contracts. There's only 38 trades. You got to know how to get in and get out. Don't worry about that. You leave that up to me. SMF will teach you how to do all of that. And we're also looking at the 800 or the $1,120 call, which got way down here at this price level. It hasn't made any big move yet. Even though it was $5 a contract, it's moved up about $8. Hold on, I got to get my level 2 back on the pricing mechanism. I'm also going to look at the 60-minute chart here on this 1120 call. It's 1120 call up and out of the money. Basically, they have some spot prices up here where they were writing them when they first came out. The last highs up here were $20, and then they went to $5. Now, folks, that was the deflated area to start buying this call, which is a hedge in case the markets gap up, in case they have a lot of short covering, that you've got that upside volatility covered in that entry down here at $6 a contract. Yes, they're nice. It was right here, $6, $6.50. Today's high, that's a $7 move. 10 of these intraday is a $7,000 whopper. What a beautiful trade. The low was only 920, but being in it the other day when the market sold off was in the deflated area here. Not quite at 5, but so what? You've got $3 between the bid and the ask. When you buy them down here and they move in that direction, you are in control of the ask. You're the market maker. They got to pay you. They're not worth 1130 right now. That's what people are willing to sell it for. Once again, we're looking at the 8/21 2010 $1,120 upside volatility call price action to minimize the short side of the market. Is that if I've got the upside volatility covered at the wholesale price, I buy and transact that trade. So if I'm on the short side of the S&P and I'm losing some value there, but I'm darn sure getting it by using the 1120 call up and out of the money at the time of the wholesale entry. Here is the daily chart once again of that S&P 500, not to mention that we have all the various puts, calls, and strike prices going out. We even have a 900 S&P that expires at the end of the year on the put side of the market, because if things fail and taxes go higher and the election gets nasty, we could break those last lows in the S&P. We're about $90 up and $90 down. We're trading right above the 1000 handle on the S&P, and we can't take out that 1106. It's got some other handles right up above that 116. You'd be looking right around that 1112, and then on the upside between 12 would be slightly around 1118, and then 1120 on the upside of resistance in the S&P is at 1092 right now. So we've got lots of professional SMF entries with risk management and wholesale prices and getting volatility to the upside, getting volatility to the downside, and minimizing capital risk exposure. Welcome to StockMarketFunding.com.